Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what we're going to do is we're going to take a little bit of a bigger picture understanding as to where we currently sit in the equity markets from a bull market perspective. Because over the past few months now, I would say that our message has been predominantly the same, which is we see risks in the market, we see issues with this market rally, but our views is to continue moving, continue to stay long because of the fact that the warning signals themselves are not a good reason to short. If you've put on any puts or shorts in this market, chances are they were very difficult to maintain and many puts have expired worthless. And that has now shifted some of the sentiment here from many investors. So today what we want to do is explore, how we're currently viewing this market right now. So before I get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, I just want to make sure everyone can hear me loud and clear. If you can please type yes into the chat window if you can hear me. Okay. Okay. Just want to make sure everyone can hear me loud and clear. So what we're going to do is we're going to start talking about the broader market update here. And what we want to do is we want to talk a little bit about in the context of the bigger picture. So before we look at charts, I want to take a zoom out of the bigger picture, going all the way back to the Great Depression, what bear markets look like, what bull markets look like, and give you an idea as far as where we currently sit in that context, because I think that will also provide some context as to how far can equity markets continue to move higher? Then we'll continue to talk a little bit about the market health, how it's declined even further. Again, the warning signs, but I still advocate that despite these warning signs and the fact that they are getting a little louder, that we still need to remain calm and stay long in this market because we just don't have a catalyst. We don't have a reason to go out there and short this market just yet. Now, I do, despite equity markets continue to get stretched and that narrative remaining the same, what has shifted quite a bit here is the dollar and the rates market. So we want to update you on what we currently see, what opportunities we see in those markets, and then share with you the economic data that we're currently looking at, especially some of the important ones that are coming out here later this week, ones that the markets have reacted fairly strongly here over the past few months, and then share with you our ideas. And if we have a few minutes here at the end, we'll open this up for Q&A. But the narrative, like I said, over the past few weeks, I think has changed a little bit. Prior for the couple of last months, predominantly the questions that I've been getting is, is it time to short the markets? Is this a market top? Are we watching a bubble? These are the types of questions that I've been getting. But over the past couple of weeks, I do have seen, more of these, of a bit of a shift here where investors are basically asking, should I just continue to buy the dips and stay long the markets? And I will say that that has been our narrative here over the past few months here, and we continue to believe in this thesis. So today, what I'm going to do is to share with you my charts, the economic research that I'm currently paying attention to, and the ideas that we currently see on the back of all of that. So like I said, I'm going to start off with a big picture. So what this categorizes since the Great Depression is the average decline in terms of a bear market, the subsequent rally back to its prior highs, and to give you an idea as far as how far those rallies historically have gone. Now, this is the typical type of seasonality analysis that many investors seem to enjoy looking at, and I think it's important, but I do again want to reiterate, when you look at seasonality, please take this with a very big grain of salt, because what this does is it doesn't put into context what has happened historically, what the market conditions were at the time. What you get is just an equal view as if all bear markets and all bull markets are exactly the same, and that's not the case. So, but it can provide some information that's interesting to give you some context. So if we look at the average bear market since the Great Depression, what we have seen is the median decline is roughly 33% of a bear market. What we have seen here during coronavirus, which is this last one, was roughly about a 33% decline. So the median move here to the downside. Now, the median move to get back to break even or get back to its all-time highs is a subsequent 50% rally. And what we've seen so far is a 51% rally. So far, the current bear market and the current bull market that we've seen subsequent to that is pretty much in line with what we've seen since the Great Depression. What has changed very substantially, though, is the number of days that it takes to have that correction. As you can see, the median was 169 days, but this one was a record 23 days on the bear market side, and the median bull market subsequent was 476 days. What we've had is a record 103 days. So this is really, into context how, despite the fact that the size of the move has been roughly the same, the speed at which this happened at an extremely accelerated version of what we have seen in history. Now, the number that I think is most surprising, the one that we really want to show you, is how far can equity markets continue to rally beyond its prior peak. Now, the data set here for this is fairly small. So again, take this with a very, very large grain of salt. But the median move after it reclaims its prior high is 46%. So imagine equity markets another 46% higher than where they are today. If you think evaluations are stretched now, imagine what it would be when the S&P 500 is trading in the 4,000s. Now, the average move is 96%. So we're talking another almost 100% gain to the upside. So again, take this with a big grain of salt, but it just puts into context that historically, when we've had these types of 33% declines, 50% rallies back to its to its relative highs, and then have another 40 to 90% gain on top of that. That's historically what we have seen. And the worst performing bull market here has still had a minimum upside of another 11% beyond its prior highs. So that just, again, hopefully helps put into context where we currently sit and just historically where markets can continue going. And that fact that the fact that we've reclaimed the highs, the fact that we've now rallied back above those highs is not uncommon, is actually fairly common, and that the actual move since then is actually substantially higher. So that is one piece of research that I did want to help take a step back, look at the big picture, and show you where we currently sit. So if we look at the S&P 500, we have roughly the same narrative. On the weekly chart, we've made a new high past the February highs. We see this negative divergence. Daily chart continues to push higher here, but momentum has now started to confirm those moves higher. So we do have that resolution of the negative divergence on the daily chart. Money flow on both the daily and weekly chart remains fairly strong. So the S&P 500 bullish trend intact and likely going to continue moving higher, advocating for more of buying the dips rather than chasing the highs. And especially when the S&P 500 RSI is now above almost 80, we do prefer to wait for a bit of a dip before you look for opportunities to go long. Similar narrative here for the NASDAQ 100 index, just obviously more stretch, well above its February highs, substantially higher, but that's that's predominantly due to the makeup of the NASDAQ 100 index, much more heavily weighted in technology, the bigger names taking a much bigger weighting. They lack the financials, so you have one of the worst performing sectors not dragging the markets, the NASDAQ 100 index lower, and then you have a higher weight towards technology. So we've talked about this negative divergence here over the past couple of months, but recently over the last couple of weeks, that negative divergence has resolved itself, and the daily and weekly money flow remains very strong. So same narrative here in tech stocks. Don't chase these highs. Wait for pullbacks. You do get pullbacks here, and the NASDAQ 100 is pretty clean in terms of pullbacks to the 20-day moving average. We haven't had one in a while, so it is possible that we're due for a pullback here into this 280 range, and then looking for a continuation higher. Now, like we said, this is where the broader market indices sit, but when we started doing these sessions back starting in April, we were talking about that in order to get a sense for whether this market rally is going to continue and the health of this market rally, we have to look at whether the broader market is keeping up. And for the most part, up until roughly June, early June, the small cap indices were either keeping up or sometimes even leading the markets higher. This is healthy for a market to continue moving higher. But ever since June 5th, this has basically fallen behind substantially. And this falling behind is those signs that we're starting to see of the market health deteriorating. And this is basically starting to happen since the beginning of June. And again, we keep warning investors, just because you see the market health deteriorating in itself is not a good reason to short the markets or to buy puts and start hedging your portfolio. You know, wait for a catalyst. We don't have a catalyst yet. That catalyst could emerge tomorrow, next week, next month, a year from today. We simply don't know. The same way how we couldn't possibly forecast or predict the coronavirus, we don't know what the next catalyst is. But we do have some of the similar warning signs that we had since in January and February, where small caps were not keeping pace. And the small caps have now stayed below this 160 level. It has consolidated. And we do expect small caps to break out of this level, break above 160, but there are some major challenges for small caps. You have the February highs at 170, you have the September 2018 highs at 173. Those are some major resistance levels small caps has to get back above in order for this market rally to start picking up steam. And we're simply not seeing that. And my base case is not for small caps to reclaim those February and 2018 highs. So this is going to, in my opinion, put a cap on the health of this market rally. Now, when small caps are not able to keep pace and the equal weight indices are not able to keep weight, and that's exactly what we've seen in the RSP, which is the S&P 500 equal weight index. You know, we've had this June high into this 113 area and has not reclaimed that area. Is it going to break out above it? I certainly think that there's a possibility of it. But right now, we still have this massive high here in February in that 118 level that is going to provide some major resistance here to the upside. And what we saw here over the past few weeks is this continuous decline in the number of stocks that are trading below its 20-week moving average right now, which is at only 43% of the market's stocks are trading above its 20-week moving average. 62% trading above its 50-week moving average, and 50% trading above its 200-day moving average. So, you know, this is telling us that the broader market is not keeping pace with the equity market indices like the NASDAQ 100 and the S&P that is telling us that markets are at all-time highs. The broader market not participating, and this is the deterioration that we've seen in terms of the health of the market rally. Another indicator that we take a look at is sector rotation. We want to see high-flying sectors like technology and consumer discretionary rotate out of that into weakening sectors. We started to see a bit of I would say rotation into materials, into industrials. That has not continued to sustain itself. It has just basically paused and started to fall behind again. So this type of market, a lack of sector rotation rather, is unhealthy for the markets. We are back to seeing just two sectors dominating the sector, which is technology and consumer discretionary, specifically the market cap indices of the technology and consumer discretionary. Because if you look at the equal weight technology and equal weight discretionary indices, they are not keeping pace at all. This is the exact same thing we saw in January and February. And what broke the camel's back was the coronavirus. So what is the next catalyst that drives this? We don't know, but these are the warning signs. Now, when we started to talk about this in late December, early January, we were already seeing these warning signs. But that warning sign continued to stretch on for about a month and a half before the coronavirus came and kind of triggered that sell-off. So can this warning sign continue to go on for months on end? The answer is yes, especially with the Fed's policy now to basically keep rates at near zero or at zero for what is now effectively unlimited amounts of time. And we don't even have an inflation target as the reason for them to lift rates. And this is what has driven this market or distorted this market that we're currently trading in. Now, the dollar has continued to weaken. This is something that we talked about here for the past, I would say, couple of months. And for the last few weeks, the dollar has stopped declining, if you will, after this. We talked about the breakdown below 96 We had a consolidation here for almost a month, and just over the past couple of days, the dollar has started to weaken again. So we do now expect the dollar to continue weaken, and now we see some further upside. So we talked about this in silver on Friday, but I think that, you know, we have started to see a move in silver, not as big of a move here in gold, but I do expect gold to continue moving higher here, from especially when you have a decline in the dollar coupled with the increasing expectation of inflation numbers getting, inflation expectations getting higher. So these are some of the opportunities that we're paying attention to here in the markets, is the dollar weakening and what that does for the rates market. Now, when we look at volatility, this is also something that, again, is a bit of a warning sign, because as equity markets, both S&P 500 and the NASDAQ 100 continues to claim new all-time highs, but volatility indexes start to rise. This is telling us that not everything is okay, that market participants are a little bit nervous, and we've seen this uptick in volatility, telling us that going into the election and starting to see this uptick in seasonality that we typically see, where VIX starts to pick up in August and September, especially during election years, we're starting to see this. So implied volatilities are getting a little bit higher, which means that selling premiums, selling cover calls, selling puts credit spreads are collecting a little bit more premium. So, you know, we're shifting between selling credit spreads, buying debit spreads, depending on the names that we're playing here. But these are ways that we want to protect ourselves, more importantly, more than anything else. Because again, when you see these warning signs, that again, I continue to stress that that does not mean you should go out and short the markets or buy puts or protect your portfolio, not just yet. Right now, if volatility picks up a little, sell some premiums, sell put credit spreads, buy call options, buy call debit spreads, because this allows you to play for further upside, but do so in a way with limited risk. Because this catalyst can emerge out of nowhere. It's the same way COVID-19 emerged out of nowhere. We don't know when it's going to trigger, and it could trigger tomorrow, and you want to make sure that your portfolio is protected. How do you protect that? It's not by buying puts, because buying puts, you know, is an expensive proposition and is only useful when you actually have that catalyst. When you don't have a catalyst, the best way to protect your portfolio is to use limited risk strategies like credit spreads and debit spreads to play for further upside. So when that catalyst emerges, you're protected to the downside. So that's how we're playing this market, and those are the ways that we continuously to show you through our daily plays. We've been using these strategies in our daily plays to show you how to play for these types of markets. Now, when we look at the rates market, with inflation expectations now continuing to rise, and it has been rising for about 2 months now, and the Fed's announcement last week that they're going to keep interest rates low even if inflation gets above 2%, that has had a pretty big ramification here on the longer end of the yield curve. So the 20-year bonds here at TLT, we've already had this double top here at 172, 172.5 before the Fed policy, but the Fed policy has now, in my opinion, potentially put this this long-term bullish move here in the long-term rates into question. Now, historically, pullbacks to the 20-week moving average have provided buying opportunities. That's exactly what we see right now. But I am concerned that this could potentially be the start of a breakdown here in the broader view here in long-term bonds. So this is one that we're paying attention to. We haven't quite broken below yet, but I do think that this could be the potential start of an opportunity here. We have made a lower low. This is something that we haven't seen in a while. We did see a bit of a breakdown here, but the markets continue to move right back up. So we'll see as to whether or not this is going to continue moving lower. But, you know, if we do get that move lower, I do see targets of this 155, 156, 200-day moving average as a potential target here for the longer end of the curve. When we take a look at the economic numbers, this is really where one of the, I would say, bright spots here in the markets. So when we look at economic recovery, so, you know, the jobs numbers that come out on the first Friday of every single month has been one that the markets have reacted very positively to for the most part for the past 3 months or so. Ever since the April lows, we've seen markets react very positively to strong job numbers. So right now we're projecting about 1.4 million jobs here added in August, which would put the unemployment rate below 10%. And I think that, if we get at least that number or potentially a little better, that's where we're going to see a continuation of markets rallying further. If we see that jobs come down significantly below this, so for example, if let's say instead of making this continuous, this V-shaped recovery starts to look more like this, that could be potentially the type of catalyst that the markets react negatively to and has a little bit of a jitter. I don't think that's going to be the case, but this is certainly one economic number that the market is looking at very strongly, and this is one that could potentially be, the type of catalyst that could start, a review of, hey, is this economic recovery actually continuing the way that the equity markets are kind of pricing in. But we do see other economic indicators continuing to surprise here to the upside. At the Dallas manufacturing survey was basically 0, which is no expansion or contraction, but the actual number came out to be about 8. So we have seen now, manufacturing continuing to improve and back into an expansion territory. And especially when you look at a lot of the retail names and some of the earnings announcements, we're seeing like Best Buy, Target, a lot of these names, right now it's not demand that's the problem, it's actually supply, meaning demand is actually outstripping supply. So we expect manufacturing to actually remain fairly strong to try to keep up with some of this increased demand, because as consumers shift away from travel, from entertainment, they're spending their money on retail, they're spending their money on home improvement. So manufacturing is starting to see an improvement from this. And this is part of the thesis as far as, yes, consumer spending is not the same as it was before, but it remains fairly resilient, and it's just shifting from one sector to the other. When we look at personal consumption, this is really, again, the consumer spending remains stronger and better than expected. The survey was 1.6% growth in consumer spending. The actual number is 1.9%. And what we've seen is actually, we've seen this huge decline in consumer spending during the months of March and April when everyone was locked down, but that has been rebounded by a surge in consumer spending, and this surge has continued to be positive. The only thing is that it's shifted away from travel into things like food and beverage, into hobbies and toys. So, we're basically just seeing a shift in consumer spending. It's not that consumer spending is necessarily declining, it's just shifting from one sector to the other. So this provides more opportunities in the market if you're looking for retail opportunities. It's just trying to capture that shift. That's where our Home Depot play comes into play. That's where our Peloton play comes into play. It's really just looking at the shift in consumer spending and playing for that shift rather than a decline in consumer spending. So some of the ideas I wanted to share with you. I wanted to take a look at some of the tech names, but I wanted to stay away from the ones, especially for those of you that maybe you're not in Tesla, maybe you're not in CRM, and you missed out on some of those big gains. So, I wanted to take a look at some of the tech names that have far stronger balance sheets, that are actually profitable, and have seen a bit of a pause here, because in these types of market environments, we don't want to chase these highs. Facebook recently broke out above that $300 level. I thought we saw a lot of chasing on those types of plays, but Facebook has now consolidated out below the $300 level. And here is the better opportunity, in my opinion, for a potential entry to take advantage and ride on the coattails of Apple and Tesla and Zoom Communications, and the NASDAQ 100 index continue to move higher in a name like Facebook, which could give you a little bit extra boost in terms of move to the upside here on a very profitable tech company that has one of the largest weights here in the NASDAQ 100 index. So Facebook is one that I'm paying attention to here in the tech name. And like I said, technology and consumer discretionary are the only two sectors right now that are beating the S&P 500. Communications has started to fall behind a little bit, and at least just keeping pace right now, not continuing to accelerate to the upside. So eBay was one that I was paying attention to, because eBay, after having a pretty significant move to the upside after those March lows from about the $26 level all the way into the high 50s, has spent the last couple of weeks consolidating. And my thesis is that you can continue to see a continuation higher here. And what you have is a fairly attractive risk to reward ratio for a potential entry, because it's just bouncing off of that support level around 54.5, which means that you have the risk to reward ratio, in my opinion, here is very attractive. At the very least, getting back to the $60 level would give you a nice risk to reward ratio, but playing for the further upside. So I would look for a continuation to the 60 level. If you get the breakout, roll that strategy higher and play for that continuation higher. And the downside risk here is fairly minimal, because if you get a decline into the low 50s, that's a good time to stop out your trade, take a few percentage points in terms of losses. We're literally talking about $3 of the underlying stock's value in terms of risk, while playing for, anywhere from 6 to an extended of, into the $20-$30 a share range in terms of potential profits, while risking only about $3 to $4 in my opinion. So this is the type of setup that I'm currently looking for here in the market, in the specific sectors that have been fairly strong. So those are the ones that I'm paying attention to. And then XRT retail. This is one that I would put on my watch list. I don't think it's time just yet, but XRT is now back to its December 2018 highs. It's, is this a double top? It very well could be, but my hunch is that it's more likely going to be a bit of a breakout here. If you look at XRT, the chart actually looks surprisingly similar to the NASDAQ 100 index, which, the two have nothing to do with each other. You've had this strong move to the upside, a triangle consolidation, a continuation higher here that hasn't, that still has some room to grow, in my opinion. And you've had this pullback here to the 20-day moving average. That is the potential opportunity that I see for a long position. But again, because you're near this double top, my preference is to be a little bit more patient, wait for the breakout before I start getting long here in XRT. And lastly, like I said, the dollar. This is really one that I think is not on most retail investors, I would say, radars. It is certainly on a lot of institutional flow that we're currently seeing out of the dollar into the euro. For those of us that were used to traveling abroad last year, euro was extremely weak. We were able to travel to Europe. It was fairly cheap for us to do so. Most of the year, the exchange rate spent below 110. Now it's closer to 120. So we've seen this move in euro, and we're talking about a multi-year decline in the euro that has now started to buck that trend. Just about 5 weeks ago, it crossed above its 200-week moving average. It has now continued to move higher. This is one that we've talked about before, where you've had this consolidation range here over the past 4 or 5 weeks, and now we're starting to see euro push higher here. So FXE is a ETF that you can utilize to play for this continuation higher here. You see this across multiple currencies. You can look at Australian dollar, which actually is, in my opinion, a slightly more volatile play here than euro. But euro is certainly one that I'm paying attention to. So euro and Aussie dollar are two that I think are potential opportunities long-term structurally. We're talking about a structural change in how the dollar is being repriced, as we've seen this decline in dollar, and the opportunities we're seeing in the currency markets as a result of that. So currency markets, not on most retail equity market traders' radar, which is why we're bringing this to your attention. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a bit of context into the macro picture as to where we currently sit from an equities perspective. It's hard to ignore some of the headlines and what we're seeing in this market. So hopefully this helps you provide a little bit of context around that. So thank you so much. I hope that you guys have a great trading day, and I'll see you guys here on Thursday for our next education event. We're going to restart our beginner options education course for those of you that are relatively new to options trading. For those of you that have experience trading, I highly recommend you come to this set of courses, because this is where we start taking a look at some of the strategies that I think are most useful for the current market environment that we are in. So even if you are an experienced trader, I think you'll learn something new about these basic strategies. And if you're brand new, this will help inspire you to get into the options markets if you're trying to figure out a way how to do so. Thank you so much. Have a great trading day, and I'll see you guys here on Thursday.